In our last lesson, we explored Mudaraba, where one party provides the cash and the other provides the labor. But what happens when both sides bring skin in the game? Today, we unlock Musharaka, the ultimate mechanism for symmetrical partnerships, shared capital, and co-founded joint ventures. Unlike Mudaraba, Musharaka means everyone is an investor. Every partner brings a portion of the financial capital to the table. Because everyone shares real asset ownership from the absolute beginning, the contract establishes a deep collective alignment of interests. The foundational architecture of a Musharaka agreement enforces a brilliant operational split between profit and loss. While profits can be divided flexibly based on a pre-agreed percentage to reward an active managing partner, losses can never be negotiated. Any financial deficit must be borne strictly in proportion to the exact capital each partner contributed. This strict loss rule prevents the exploitation of capital. In a conventional corporate setup, special clauses can shield preferred shares from taking losses, shifting burdens unfairly. Shariah jurisprudence states that if a venture loses money, the capital must bleed proportionally. If you put in 70% of the capital, you absorb exactly 70% of the loss. When it comes to operations, every partner holds an inherent right to participate in management. However, Musharaka is highly flexible. The partners can mutually agree to appoint a single individual to act as the managing director, increasing that partner's profit share to fairly reward their daily execution and labor. How does this scale to modern consumer finance? Look at how ethical institutions completely replace the concept of a predatory interest-bearing property mortgage. They use a dynamic variation called diminishing Musharaka. Instead of lending you money and charging interest on a debt, the bank enters into a joint venture partnership with you to buy the house together. If you provide 20% of the capital, you own 20%. You then rent the bank's 80% share at a fair market value. As you pay rent, you buy out pieces of the bank's equity over time until you own 100% of the asset. For corporate leaders and tech entrepreneurs, Musharaka provides a resilient alternative to heavy debt leverage. Instead of suffocating a new business branch with fixed interest payments during a market downturn, a Musharaka joint venture aligns the financing entity directly with the ups and downs of the operational cycle. The Musharaka model illustrates that real financial sustainability is achieved when we step away from risk-shifting loans and step into genuine risk-sharing partnerships. Now that we have decoded the two master models of equity partnerships, we need to look at how ethical systems handle physical asset trading and commodity procurement without using interest-bearing credit lines. In our next lesson, we break down Mudaraba, the cost-plus financing model that anchors global trade finance. Hit subscribe, and let's keep building wealth with a conscience.